2-month anniversary of joining Deaglo. So this is a big deal for me. As way of background, I spent about 25 years in institutional foreign exchange at primarily Morgan Stanley, briefly at Deutsche Bank and Nomura. And as I said, 2 months ago, I joined Deaglo, and I'm so excited about the tools that we have to help investors hedge their FX costs, as well as looking at payments and other things that we will introduce along the way. I'm joined today by Matheus Zani, who is a true LATAM expert. He's going to handle kind of the middle part of the presentation, and he is a great account manager and has been at Deaglo for a couple of years now and is a key part of the team. Before I dive into the presentation, if you wouldn't mind, if everybody could just sign into the chat function, letting us know who you are and what your affiliation is, that would help us as we move forward with Deaglo. The other thing is, if you could hold your questions to the end, we'll have a Q&A session. If you want to put some questions in the chat, that's fine too, but unless it's super urgent, we're asking that you keep them till the end. So just diving in now, Deaglo was founded in 2019, and we're a fintech firm that offers FX risk management solutions to institutional funds, raising foreign capital for investors relocating overseas and corporations expanding and operating globally. Deaglo's tools provide insights, explain the currency risk associated in cross-border transactions, and highlight the steps to mitigate it. Given my long experience in foreign exchange, I am amazed at the powerful technology that has been built and is continuing to be built. And we want to make sure that everybody understands it. And we are supported here at Deaglo by the best FX minds in the world. And we want you guys to be a part of that as well. By way of what we're doing already, we are helping some of the biggest names you can see on this slide raise and deploy more effectively and efficiently capital and manage their FX risks associated with it. So you can see we have investors, we have fund managers, we have portfolio companies. So this is something that we think is very applicable, and it will help all types of investors. So why are we focused on LATAM? Good question. I think this slide really highlights it quite effectively. You can see that LATAM currencies have historically experienced very high levels of annual volatility. You can look in the box there. You can see the Mexican peso, Brazil, Chile, Colombia, Argentina, very high levels of annual volatility. It's going to be attributed to a number of factors: political instability, economic uncertainty, dependence on commodity exports, which obviously fluctuate dramatically, foreign investment flows, and then currency speculation. These factors can create uncertainty, risk aversion, and sudden fluctuation in the exchange rate, which Deaglo hopes to help mitigate and help all you guys as investors. Potential loss incurred in a global portfolio is kind of outlined in this slide right here. Obviously, very relevant, very significant, and you can see some of the example here. $100 million portfolio, 5-year time horizon. The potential loss is dramatic and obviously speaks to the need for hedging and objective hedging, which is what Deaglo helps you understand and provide the tools to do. And so regardless of FX risk management or how you handle it, FX hedging enables fund managers to achieve their long-term investment objectives. You can see in this slide, fund level hedging is focused on protecting the overall value of an investment fund, and portfolio investing is focused on protecting a specific investment portfolio. We're going to run through some of the challenges, but you can see them listed here. Matheus will talk about them in more detail, but hedging costs, liquidity constraints, valuation, predictability, and complexity are all challenges that I'm sure you're all aware of, and we hope that we can help you navigate these challenges. So having said that, I am going to turn this over to Matheus now.
John, before I kick off my part of the presentation, I'd like to quickly introduce myself. My name is Matheus Zani. I'm the head of Latin America. I work closely with asset managers and global investors, help them to handle currency risk when fundraising or deploying in the region. Most firms think that the hedging cost is just one component, but the truth is there are different components. Okay, so here I will be speaking about costs that fund managers may encounter when managing currency risk in the region, and these include transaction costs, BDS spreads, carry costs, credit facility charges, and finally, cost of opportunity. So Let's kick off this presentation with the transaction costs. Transaction costs are the fees charged by FX provider for executing trades. We can have brokerage fees, commission fees, and intermediary fees. In general, this cost depends on the size and complexity of the trade, and of course, the liquidity of the market. For instance, in Latin America, countries such as Brazil, Mexico, liquidity not very often is an issue. However, in Colombia, Peru, or countries from Africa, the lack of liquidity can be a huge issue. Okay. BDS spread. BDS spreads are the difference between the price at which financial institutions are willing to buy and sell a currency. Basically, this spread represents the profit margin for market makers, and it can vary widely, depends on the currency pair being traded, the liquidity of the market, and the time of day. So, for instance, in Peru, the best time to book a trade is between 10 a.m. to 12 p.m., where this BDS spread will be much narrower. So, carry costs. I would say this is the most relevant component in this presentation, and one that fund managers should pay attention to. Carry costs should be understood as a hedge impact more than a cost itself. Now, even though both terminologies, hedge impact, carry costs, are used with the same meaning. Basically, this hedge impact is the interest rate differential between the rates in country A and rates in country B. And this difference is illustrated by forward points. Forward points can be added or subtracted from the spot rate to arrive at the forward exchange rate. So again, we can add or subtract from the spot rate to arrive in the future rate, in the forward rate. Okay. So for example, as the Brazilian real has a higher yielding than the US dollar, in other words, the interest rates in Brazil, Selic, are higher than the US, forward points are positive. This situation happens with most emerging market currencies. For example, let's say Colombian peso, Mexican peso, Chilean peso, South Africa rand, Kenyan Chilean, India rupee, and so on. The list is large. So I want to illustrate this market behavior through two different images. And let's take Brazil as example. This table from Bloomberg shows the interest rates from 1 week to 1 year for each country. The first column is the US deposit rates, and the second one is the interest rates in Brazil. Okay. Then we can see the respective forward points that will be added to the spot rate. So, for example, if the Brazil real spot rate is trading now at 5.19, the forward rate for 12 months out for 1 year is 5.51, which means that the forward point or hedge impact for the period 12 months is around 32 cents. Okay, and as you can see in the chart on the right, the hedging cost in annualized terms is around 7% per year across different tenors, across different maturities. The situation, let me give you other examples, and the situation is the same. It can also be seen in Colombian peso, where the hedge impact, the carry cost, is near to the highest level in the last 5 years. And most importantly, this forward curve is dynamic and non-linear. What does it mean? It means that each tenor has different hedge impacts. 3 months, 6 months, 9 months, 12 months, and so on. So each one has a different hedge impact. And because of that, it's so important to analyze the maturity of the contract that will be booked. Okay. Another example in the region, in Mexico, occurs the same. The hedge impact is a bit above 7% per year, and again, and most importantly, this forward curve is dynamic and non-linear. I want to now provide a little bit more color about this carry cost because it's very important. So I want to illustrate this hedge impact through a quick example here. Please don't worry about taking notes. I know there's a plenty of tests here, I will be sharing this presentation of the webinar ends. In this example, a Brazilian fund manager wants to hedge their capital distribution in BRLs against the dollar, exactly to ensure that the potential depreciation of the BRL will not affect negatively the dollar's USD returns. So the direction of the hedge is to sell local currency. In this case, in this example, is Brazilian real, and buy the US dollars. So in this direction of the hedge, there is a negative hedge impact due to the carry. Okay, the capital distribution in this example will occur 12 months out, and as you can see in the diagram on the right, let's say the BRL spot rate is trading at 520, and for 1 year that you want to protect your exposure, the forward rate is 5.5467. Okay, this means that the manager will convert their BRL into dollars using a rate of 5.5467. Okay, so this difference between both rates, spot and forward rate, is 6.67%. This is the cost. Okay, so let's provide a little bit more color here. So the total cost of the 40 points in this example would be over 346,000 reais. Okay, which is that 6.67% on the notional that will be protecting with the hedging. I know this can be relatively high. So our job here at Deaglo is to help fund managers like yourselves to choose the right hedging products to reduce this hedging cost. And a great example of a hedging product is options. Okay, we'll be discussing later in this presentation our tools that help our clients to choose the right products. Okay, so let's talk now about credit facility costs. Credit facility costs are another very important component, okay, in this discussion about hedging costs in LATAM. This can be very costly as well for the asset manager. So banks and other FX providers, they charge their clients based on counterparty risk and the transaction structure. Okay, if the flow goes to several SPVs, onshore, offshore, pass-through vehicle, master fund, feeders, etc., also add some complexity in the transaction. Okay, usually, if the manager is able to access unsecured and margin credit lines, this cost, the credit cost, tends to be higher. If the asset manager doesn't have credit lines, this cost tends to be lower. The logic is simple. The counterpart is assuming your risks, so they will charge you to do it. Okay. Another example: you are requesting credit facilities, but you have an insufficient credit history, so the credit costs might be higher. For this counterpart, provide you with thresholds with zero initial margin, zero variation margin, or some threshold. Okay. So the last item, but not the least, cost of opportunity. This is also known as collateral drag. Okay, basically, this is the deposit collateral required as initial margin and variation margin. Okay, the higher is the capital that must be allocated to hold your hedging positions, the higher will be the cost of opportunity. Okay, why? Because the manager you not be allocating the capital committed, or the capital from their investors into the fund, but the capital will be allocated to hold their trade positions. This can drag the performance of the fund substantially. Of course, depends on how much you need to hold to pay the initial margin, how much you need to hold for variation margin. Okay, but in general, this can drag the performance of the fund substantially. Okay, so let's refresh what we discussed here so far. I discussed here about 5 hedging cost components. The first one, the transaction costs. The second one, bid-ask spreads. Carry costs that I mentioned is one of the most important here. Credit facility charges and cost of opportunity. Okay, so now the idea is to discuss a couple of strategies for managing these costs properly. Um, I know, again, a lot of tests here. Unfortunately, I'll not be able to speak about all of them, but again, I will be sharing this presentation later today with you all. Uh, the first item, transaction costs. Now, how we can optimize the trade execution? We can negotiate fixed spread with your counterparts. In this way, you'll be executing all your trades, whether it's a payment or hedging, with the same spread every single time with the same spread. Okay, uh, you're in doing this, your cost will be transparent and fixed over time. Okay, you can also use capable FX counterparts and channel. For example, you can trade, you can do you can book your transaction through electronic platform, uh, through offline execution. You can call the FX desk, you can send an email. You can also use onshore versus onshore rails. Okay, you can use value provider that's able to access local rails to get a better pricing. Now, all these strategies goals, is the goal of all these strategies to minimize the transaction costs. In the end of the day, this also adds the costs into the hedging program. Okay, optimizing tenors. That's very important as well. So what do we do here? We analyze the historical and the current interest rate differentials to identify the tenor that offers the lowest carry costs. Okay, as you see in the beginning of this presentation, this carry cost can be north 7%, 6%. It's a substantial number, okay, relevant number. So the same as you mentioned here in Brazil, Colombia, Mexico, often they have a carry cost. We can also evaluate market expectation. Okay? Usually, asset managers also consider the market expectations for interest rate differentials. So let's say that the Federal Reserve, you continue to hike rates through 2023, and the Mexico Central Bank, Banxico, you start cutting these rates also this year. So it's also worth considering short-term maturities than long-term maturities. We also need to do this assessment on the market view, how the central banks you act to in terms of interest rates for each country. Okay. Um, Multiple hedging products. I would say that's a very good managing strategy to adopt. Some asset managers, they hedge their exposure only using NDFs. Other only hedge using options. Other hedge their exposure only using swaps. I'm not saying here that one's right, another is wrong. But what I want to propose here is that diversify your hedging instruments. Choosing that those that you are able to avoid these adverse 40 points is an excellent strategy. Okay, and here at Deaglo, we developed a statistical tool using Monte Carlo simulation, okay, that helps our clients to take a more informed decision when choosing a hedge instrument. Okay, this tool allows assessing the performance of multiple products such as forwards, NDFs, which is in non-deliverable forwards, vanilla options, and structured option products, and so on. Swaps. We are able to run several simulations using Monte Carlo simulation to assess the performance of each strategy. Okay. What does it mean? Why use the Monte Carlo simulation? Because the outcomes from this tool provide much more insights than bank payoff diagrams, which don't give any knowledge of the likelihood of the outcomes, likelihood of the performance of that specific instrument. Overall, through this tool, it's possible to identify which product, which hedging instrument will reduce the negative impact of the 40 points, reduce this carry costs, okay, the most, protect against tail risk, and allow the furthest upside participation. Okay. Another tool I want to describe, another tool that we also have developed here at Deaglo, And so I want to discuss here a few strategies that help you reduce the collateral drag, and credit charges as well. So what you can do, for example, we can negotiate more favorable collateral terms and requirements. Okay, so when you negotiate ISDAs, credit support annex, and other paperwork with your counterparts, you can negotiate it with more favorable terms. You can diversify your bank panel to avoid collateral risk and ensure competitive bank relationships. And as I said, I want to discuss here one of your tools. This is a statistical tool to understand what are the likelihoods and levels that you trigger margin calls. Uh, every single time when I speak with the asset manager or global investor, they ask me about the cash requirements, about the margin calls. So we developed this tool exactly to answer such questions. Okay, so this statistical tool is called margin determination. Okay, so which helps managers to optimize the funds held back. Okay, so our technology display the distribution of potential margin calls requirements for each hedging product. Okay, so for example, we can figure out what is the likelihood of a potential margin call when using NEDFs, when using forwards, using a collar, using a seagull, using a three-way, and so on. Okay? And also with different hedge ratios. Uh, one thing that we need to discuss here as well is the hedge ratio. Not necessarily you need to hedge 100% of your exposure. A plenty of analysis we do here is towards to answer this question. Okay, if I have 7% of my exposure, I will be protected. I will be able to reduce my tail risk. Okay, and also using this tool, we are able to assess the potential margin call in different hedge ratios for each hedging product. Okay, so I would say this is a very innovative, very useful way to choose the right products using statistical evidence and not emotion. So what we're talking here is about remove the emotion and add more statistical evidence in order to take a more informed decision. Okay, so that is from my side. I want to call my colleague John Silver again to talk about a couple of best practices and write up this webinar. Guys, thank you very much for your time. Please, John.
Matheus, great job. I know we covered a lot there, so we'll have a little time for Q&A at the end. And as Matheus mentioned, we're going to send out the presentation to everybody. So I just want to talk briefly about best practices. And you can see in this slide, we lay out kind of what we think are the 4 pillars of best practices: setting clear hedging policies, establishing appropriate risk limits, monitoring hedging performance, and communicating effectively with treasury, finance, and the risk management teams. Deaglo and the tools that we have and the people that we have here can help with all phases of this control of FX hedging costs. We can offer, as Matheus mentioned, I think this is a very important point, objective analysis. I worked at banks for many years, and you don't often get objective analysis from a bank. They have positions, they have risk limits, they have a lot of things which might skew how they're going to talk to you about controlling your FX risk and your FX costs. So I think that's a big point to mention. You can read through this slide and see see the details in each one of these, but very important points here about controlling costs. The next slide, we have a couple of case studies and examples which we believe show the depth and breadth of Deaglo's capabilities. For Spectra Investments, we were able to save 50% on FX costs for them and 0% initial and variation margin. Very powerful and very important tools for Spectra. In the Bally-Bunyan case, we reduced their FX hedging cost by 47% with an expected improvement on ROE of 10.5%. We were able to renegotiate fixed spreads with our current broker and work on their monthly rollover strategy with them. So I think those are 2 examples of how we've been able to positively impact some big investment managers. And just in conclusion, I want to run through a few important points here. Potential losses from currency fluctuations can be very significant. A hedging strategy should be considered at all times to protect an investor's portfolio. Our analysis might show that you want to hedge or you might not want to hedge, but it's important to go through the analysis. And effective management of hedging costs is crucial to achieve long-term investment objectives. We believe our tools are best of breed to help you in this respect as well. The strategies and practices we discuss in this webinar can help fund managers optimize hedging programs, which is super important, and achieve better outcomes in managing FX costs. And the last point is, by implementing these strategies, fund managers can minimize costs, reduce risk, and enhance overall portfolio performance, which I know is why you're all here today. So on that note, I just want to thank everybody for joining, thank Matheus, and thank Johnny, and we can open up the floor to questions now.
Great. Thanks so much, guys. Yeah, we really, booked this time so that you guys can ask questions. This is our area of expertise and something that we're really, really passionate about. We know a lot of people out there might be kind of either on the newer side to, hedging, or maybe even newer to emerging markets, depending on what kind of fund you are. But if you guys, have any questions, feel free to unmute yourself or put it in the chat now.
And also feel free to email myself, Matheus, and we're happy to answer any questions. But if there's anything now, we're happy to address it as well. Okay.
Great. And if not, we'll probably be following up via email. If anybody wants to get access to our platform as well, it's something that we're going to be charging a monthly SaaS fee in the future. But right now, you guys can get it for free. So feel free to reach out. I will be sending a follow-up email. And if you want time to, sit down and figure out how to use that platform, that's something else that we're happy to do as well. And if nobody has any questions, we can end the meeting here. But we'll give people just another minute in case they've got anything else remaining. It can even be specific to your fund or your corporate or even a scenario that you've encountered and we're wondering what to do. We're really happy to dive into anything specific.
Hi, Johnny and Matheus. I do have a question. By the way, I'm Rafael from Prisma Capital. I used to work for a bank where the credit department would set a counterparty risk minimum spread to be applied on the final forward rate, which would be charged from clients. And it was usually calculated based on an estimate of volatility of the pairs being traded. And then we'd establish a spread on that assumed risk. And then at the end of the day, it would be added to the client's final rate. I was wondering if we assume that whatever extra points are added to the, let's say, to the ask forward rate, if we assume that all of that was related to credit risk, is there a way to, or what would be the best way to translate that into a spread? I mean, we'd have to find a potential loss, let's call it that, amount, and then apply the spread, I believe. But what I saw there was a slide that measured an estimate for a 5-year period, and I think that's part of the answer for what I'm asking. But what's the best way to, let's say, replicate this analysis of a 5-year estimated volatility of the trading pair? I don't know if my question was clear.
Let me see if I understood. Let me try to answer you. In terms of how much your bank is charging you due to the credit, each counterpart, they run their own credit analysis. They have their own model. They have their own tools to specify your costs. Okay, so usually they run a credit tool, a credit analysis based on your financials. Okay, the first thing is on your financials. The second thing is how you are hedging your exposure, which products you are hedging through NDS, option, and how far you go with your instruments. You'll be doing a monthly roll and roll it a monthly basis, or you are booking this quarterly basis and roll it. It's 3 months and so on. Usually, the counterparts they require this kind of inputs, financials, which products, how you'll be deploying these hedging products. Okay, so they will figure out X basis points that you'll be charged. Okay, the forward points, as you mentioned, the forward points depends on the market environment. Okay, depends completely on the market environment, on the interest rate differential for each country. Okay, you can see here this curve is not linear. The first thing. Okay. But another thing is what is important: the liquidity of the market. For example, in Brazil, with the Brazil real, it's quite difficult. Some counterparts offer you the possibility to book a trade after 1 year, for example, or 18 months. Okay, so the counterpart might be able to execute 18 months, but the liquidity you be poor, so they need to charge you because this liquidity. Maybe it's easy to enter in this contract, but it's difficult to leave this contract, like to close this contract. So the bank, the counterparts, they also charge. If you want to go in some tenors, that is difficult to find liquidity. Okay, so they will find one way to incorporate this lack of liquidity in your spread.
Thanks, Matheus. I think that's a good slide to illustrate my question. And there's another one right in the beginning where you said a 5-year time horizon, potential losses to the Brazilian real in a $100 million trade are 135.6, right? It's really early on, right? So I think my question is, let's say I do close a 5-year hedge, although it's very unlikely, but let's say I do it. Could I assume that whatever I'm being charged beyond the forward rate is a spread to compensate this $135.6 million potential loss that the bank would incur if I defaulted?
Yeah, what I want to show here in this slide is the potential loss if you hold some assets by 5 years. Okay, this is the value to risk. So we are considering here the historical annual volatility to do this calculation to calculate the VaR. First, unfortunately, you'll not be able to hedge 5 years straight. Okay, because again, we don't have it in the Brazilian market. At least we don't have any product that's always able to cover this whole period. So maybe you hedge this for 12 months, 18 months, and then you need to roll the positions. Okay, so you'll be protected for this period where you are able to trade. You're able to book your derivatives, but for the rest of the time, you have some exposure. Okay, how the bank is calculating, analyzing this situation to charge you, I don't have this answer. Okay, depends on each counterpart. Okay, our job here is to provide you a big picture of your potential loss and figure out potential hedging programs, considering your investment cash flow. Okay, and through the technology, through our tools, identify what is the best hedging product, what is the best tenor. Should I hedge 6 months and roll this, or 12 months? I should do this 3 months using a collar, then the next roll using an EDF, and so on. All this dynamic of a hedging activity, we are able to help you with. Regarding how the bank you look to your potential loss and prices, to be honest, it depends on each counterpart.
It's okay. It's clear. Thank you, Matheus, very much for the presentation.
Yeah, I just wanted to add on that. The 5-year tenor, as Matheus said, doesn't really exist in Brazil. And what we can help with is the dynamic changes that happen in the forward curve and the option curve. So you might want to do a forward 6-month forward in the beginning, but interest rates change, currency rates change, spot rate changes. So you may want to do something for the next 6 months. So I think that's an important point. And thank you very much for the question. Anybody else?
Great. Well, thanks so much for coming. Hopefully this was helpful and informative. Follow us for more information about FX hedging. We're probably going to be having similar webinars on different topics, but still in this space. So be on the lookout for those as well. And if you ever want to get access to our platform, just reach out to us.
Thanks very much, everyone.
Very much. Take care. Bye-bye.